Broadcom is one of the companies that have been most significantly impacted by the tariffs announced by President Donald Trump. Broadcom stock is now down almost 33% year to date in 2025. Broadcom primarily outsources its manufacturing to companies like Taiwan Semiconductor Manufacturing. Broadcom has operations in Taiwan, Singapore, and Malaysia, so it is going to be impacted by these tariffs. Now, momentarily, semiconductors have been excluded from these tariffs, but I don't think as investors we should become complacent that that would remain the fact longer term. The present administration is keen on placing tariffs on companies that are importing goods from outside the United States, trying to encourage companies to manufacture things here domestically. So for now, maybe semiconductors are excluded, but that might not remain the case longer term. So in this video, I'm going to answer the question if Broadcom stock is a buy at current valuations.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So to evaluate this company, I wanted to look at it longer term, not just focus exclusively on these near-term impacts from tariffs. And Broadcom has done a great job growing revenue at $54 billion in the most recent trailing 12-month period, up from around $7 billion in 2015. Broadcom has been a very acquisitive company. Its most recent acquisition, VMware, the company's just digesting that other company as we speak. Management has said that it's still finding synergies and cost savings as a result of the acquisition, and it's going very well, much better than expected. Additionally, the way impacts from these tariffs will hit Broadcom is a result of declining consumer demand for electronics. Now, this is going to be broad-based, I think. I think demand for smartphones, tablets, laptops, personal computers, cars, refrigerators, washing machines, dryers, etc., vacuum cleaners, all of these things, the price of these things are going to increase because the vast majority of these things are manufactured outside of the United States. So bringing them into the United States, these businesses will face a higher cost of goods sold, and they're likely to pass on those higher prices to customers. And when customers see higher prices, they're probably going to buy less of these things. So if people were accustomed to upgrading their smartphones every 3 years, that's likely going to change and become more distant. So every 4 years instead of every 3 years. For tablets, every 5 years instead of every 3 years, etc., etc., all along the line for electronic devices, because the cost of each one of these things is going to increase. I mentioned that Broadcom is still finding synergies, and management said, if you can see that big dip here in their cash flow from operations to sales ratio, that's a result of the acquisition. And management said that was okay, that was to be expected. But given what they've seen so far from VMware and Broadcom, the combination, the redundancies where they're going to be able to lay off some people and some cost cutting, right? You don't need two headquarters, you don't need two office buildings, you don't need two boards of directors. And so they're going to find those synergies and reduce cost, and at the same time cross-sell their businesses across categories. And management is confident that they can return to their cash flow from operations from before the acquisition, so back above these 50% levels, which are excellent, right? If you've been following my videos, you'll notice that the 50% CFO to sales ratio is among the best of all of the companies I follow. It's in the top 10 for sure. It's not number one, it's not number two, but it's up there at the 50% range of being one of the best of all of the companies I'm following. The return on investor capital is less excellent for Broadcom. You can see a lot of cyclicality in this figure going up and down. The business, like I said, very acquisitive, so they've been adding new businesses into the structure, and so that's made it difficult for Broadcom to get better and learn about how to operate most efficiently, and the continued outlays in capital to make those acquisitions is weighing on the company's ROIC at 7.22%. It's not very good. However, if they can return the numbers up to above 20%, that would be much more attractive for longer term investors. And given the company's recent ability to do that, I think investors can be reasonably confident that they can return their ROIC levels up over 20%. Looking at valuation, I adjusted my discounted cash flow model again this morning for Broadcom. There's been so many moving parts here. I've been updating my spreadsheets very frequently because of the rapid changes in the macroeconomic environment. So my new discounted cash flow or fair value per share for Broadcom is $173 per share. That compares well to the current market price of $156. It's just enough out of the range of margin of safety where I can say the stock is undervalued, right? The margin of safety I would use in this case is 10%. So about $15, that would bring it up to 171. So at 173, it's out of that range. So I can say it's undervalued. And then when I measure it based on the forward price to earnings at 19.92, it's about the lowest it's traded for going back 1 year. So this is the cheapest you've been able to buy Broadcom stock in the last year. If I zoom out and look at it over a 3 year period, it's been at this price before, so it's at about the higher end of the range over the last 3 years. Well, I should say the middle end of the range of the last 3 years. So over the last 3 years, it's traded more cheaply, but in the last 1 year, this is the cheapest you've been able to buy Broadcom. And of course, the reason the valuation had gotten more expensive in the last year because Broadcom was benefiting significantly from the rising demand due to artificial intelligence. And I think that's still going to be the case, albeit it's going to be spread out a little more. Whereas AI demand was so heavily concentrated in the near term, like in the next 1 to 3 years, I think those spendings will be pushed out a little bit. Businesses will pause and slow down some of that investment until they get more certainty about the current macroeconomic environment following the tariffs. So to answer the question, is Broadcom stock a buy at current valuations? I last had it rated as a borderline buy, and given the changes here, what we have is a lower stock price for Broadcom because of the recent sell-off, but at the same time we have greater risk, much greater risk because of the sell-off. So I really like the business, but the near-term risks are so elevated. I'm not going to upgrade the stock, but I'll keep it rated as a borderline buy. And a borderline buy to me is something between a buy and a hold, but closer to a buy. And I'm encouraged by the fact that just a couple of days ago, management announced a new $10 billion stock buyback. So management feels that its shares are undervalued right now, and they're spending $10 billion to buy back their shares. Hey everyone, we've got some exciting news to announce. We launched a private Discord exclusively for our channel members at the VIP Discord tier. It's your backstage pass to ask questions, share insights, and get direct access to me. Don't miss your chance. Limited spots available, so join now.